Smart investing. 5 simple yet effective principles. Investing can seem daunting. Wall Street jargon, complicated charts, and the sheer volume of information can overwhelm anyone. But at its core, smart investing is about applying a few simple, yet powerful principles consistently over time. Forget the get-rich-quick schemes. This is about building wealth the smart way. Here are 5 principles that, if followed, can significantly increase your chances of investment success. 1. Know thyself. Define your goals and risk tolerance. Before you invest a single dollar, you must understand your personal financial landscape. This means answering some crucial questions. What are your financial goals? Are you saving for retirement, a down payment on a house, your children's education, or something else entirely? The timeline for your goals will heavily influence your investment choices. A goal 30 years away allows for more risk than one 3 years away. What is your risk tolerance? How much of a potential loss are you willing to stomach in exchange for potentially higher returns? If the thought of losing 20% of your investment keeps you up at night, you're likely risk-averse. If you're comfortable with larger swings for a chance at greater gains, you're likely more risk-tolerant. Investing without a goal is like sailing without a destination. You're likely to drift aimlessly. Understanding your risk tolerance prevents you from making emotional decisions during market downturns, which is a common mistake that derails many investors. Sit down and write out your financial goals. Be specific. For example, retire at age 65 with $1 million. Then, honestly assess your risk tolerance. There are online quizzes that can help with this. 2. Diversify, diversify, diversify. This is perhaps the most repeated and arguably the most important principle in investing. Diversification simply means spreading your investments across different asset classes, industries, and geographic regions. Asset classes. Invest in a mix of stocks, representing ownership in companies, bonds, representing loans to governments or corporations, and potentially real estate or other assets. Industries. Don't concentrate your investments in a single industry like tech or healthcare. Spread your investments across various sectors. Geographic regions. Consider investing in international markets as well as domestic ones. Diversification reduces your overall risk. If one investment performs poorly, the impact on your portfolio is mitigated by the performance of your other investments. It's about limiting your exposure to any single point of failure. Consider investing in low-cost index funds, or ETFs, exchange-traded funds, that track a broad market index like the S&P 500. These automatically provide instant diversification. 3. Invest for the long term. Investing is a marathon, not a sprint. Trying to time the market, buying low and selling high consistently, is extremely difficult, even for professionals. Instead, focus on long-term growth. Ignore the noise. News headlines and daily market fluctuations can be distracting. Don't let short-term volatility influence your long-term strategy. Dollar cost averaging. Invest a fixed amount of money regularly, regardless of market conditions. This helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. The power of compounding, earning returns on your returns, works best over long periods. Time in the market is more important than timing the market. Set up automatic contributions to your investment account each month. Even small, consistent contributions can add up significantly over time. 4. Keep costs low. Investment fees can significantly erode your returns over time. Be mindful of the fees you're paying for. Expense ratios. These are the annual fees charged by mutual funds and ETFs to cover their operating expenses. Look for low-cost options. Transaction fees. Some brokers charge fees for buying and selling stocks or ETFs. Choose a broker with low or no transaction fees. Management fees. If you're using a financial advisor, understand how they are compensated and what fees they charge. Even seemingly small fees can have a large impact over the long term. For example, a 1% annual fee can reduce your overall returns by a significant percentage over several decades. Compare the expense ratios of different index funds or ETFs before investing. Choose a brokerage account with low fees. Consider using a robo-advisor, which typically offers lower fees than traditional financial advisors. 5. Stay informed. It's crucial to stay informed about your investments and the overall market. However, it's equally important to avoid overreacting to short-term news or market fluctuations. Read reputable sources. Get your financial information from reliable sources like the Wall Street Journal, Bloomberg, or reputable investment websites. Review your portfolio regularly. Check your portfolio periodically, for example, quarterly or annually, to ensure it still aligns with your goals and risk tolerance. Rebalance as needed. Over time, your portfolio may drift away from your desired asset allocation. Rebalancing involves selling some investments and buying others to bring your portfolio back into alignment. Staying informed helps you make educated decisions about your investments. Regular review and rebalancing ensure your portfolio remains aligned with your long-term goals. Schedule time each month to read financial news from reputable sources. Review your portfolio at least once a year and rebalance if necessary. Smart investing isn't about finding the next big thing or chasing quick profits. It's about understanding your goals, diversifying your investments, investing for the long term, keeping costs low, and staying informed. By following these 5 simple principles, you can significantly increase your chances of building wealth and achieving your financial goals. Remember, consistency and patience are key. Investing is a journey, not a destination. Good luck.